On August 21st, 2025, the world woke up to a financial shock that sent tremors through every corner of the global economy. Former President Donald Trump announced a sweeping 25% Patriot gold tariff on all gold imports into the United States. The news broke overnight, catching investors, governments, and financial institutions completely off guard. The message, delivered directly to his millions of followers on social media, was blunt and unmistakable. Protect American mining jobs, secure the nation's gold reserves, and put America first in the global gold market. Trump's words echoed across the country, stirring both fierce support and immediate backlash. This wasn't just another economic policy announcement. It was a bold declaration of economic warfare, a move that challenged decades of international trade norms and threatened to upend the delicate balance of global finance. Markets thrive on stability and predictability, but this announcement triggered instant chaos. Traders and investors scrambled to make sense of the new reality as uncertainty gripped the financial world. Gold prices spiked to levels not seen in years. Traders frantically bought and sold, and the global financial order was suddenly thrown into question. The shockwaves rippled through every major exchange. A 25% tariff would effectively split the gold market in two, one price for the United States and a different one for the rest of the world. This unprecedented move threatened to create a fractured, unpredictable marketplace. Uncertainty spread instantly, forcing investors, institutions, and even central banks to rethink their strategies. No one was immune to the sudden shift in the rules of the game. Was this a genuine policy shift or just political theater designed to rally a base? The debate raged on, but one thing was clear. No one could afford to ignore it, not even for a moment. Gold, long considered the world's ultimate safe haven, was now at the very center of a financial storm. Its role as a stabilizing force was suddenly in question. The world held its breath, watching and waiting to see if this was merely a high-stakes bluff or the beginning of a new era in global economics. Every second felt like an eternity. Within minutes, the ripple effects were felt across continents. Stock exchanges from London to Tokyo reacted, and currency traders scrambled to adjust their positions. The rules of the game had changed overnight, all from a single, explosive message that no one saw coming. The world was left to wonder, what would happen next? What's a tariff? It's a word you might hear in the news, especially during heated debates about trade and the economy. Simply put, a tariff is a tax placed by a government on goods that are brought in from other countries. It's one of the oldest tools in international trade. For example, if the US decides to put a tariff on Swiss watches, those watches instantly become more expensive for American shoppers. The extra cost is added at the border. The main goal? To make foreign goods less appealing and give a boost to products made at home, supporting local jobs and industries. Tariffs are a form of economic protectionism, raising barriers to shield local businesses from outside competition, sometimes sparking strong reactions. But there's a catch. Countries hit with tariffs often fight back by imposing their own tariffs, leading to trade wars that can escalate quickly. Tariffs can drive up prices for everyone, not just for big corporations. Everyday people feel the impact at the checkout counter. Businesses pay more for imported materials, which means they often have to raise prices on their own products, passing those costs to consumers. Everyday items, from electronics to clothing and even groceries, can get noticeably more expensive, affecting family budgets. Protecting one industry can mean higher costs for millions of people, making life more expensive for everyone. Gold tariffs are especially disruptive, because gold isn't just another product. It's a symbol of financial security. Gold is a global financial asset, a safe haven in times of uncertainty, and its price affects markets everywhere. Taxing gold can shake the very foundation of international finance, causing ripples that reach far beyond borders. It's like taxing the world's emergency fund, creating uncertainty where there should be stability and trust. The consequences? They can be far-reaching and unpredictable, affecting economies, businesses, and families around the globe. Well, news of the gold tariff sent Wall Street into a tailspin. The Dow plunged, the fear index soared, and traders were gripped by panic. If gold, the ultimate safe haven, wasn't safe, what was? Algorithms failed, fear took over. London's gold markets were thrown into turmoil, unable to price gold with a looming US tariff. In Asia, markets bled red, and investors rushed to safer currencies. The US dollar weakened as global trust wavered. Boardrooms everywhere held emergency meetings, freezing billion-dollar decisions. No one wanted to move until the chaos settled. The uncertainty was paralyzing. The world watched, waiting for clarity. As U.S. markets panicked, investors rushed north, straight to Canada. The sudden uncertainty south of the border sent shockwaves through the financial world, and Canada quickly became the destination of choice for those seeking safety and opportunity. Canada's stable politics and massive gold industry made it the new safe haven. Investors saw Canada as a fortress of reliability, with its government and institutions inspiring confidence even as chaos reigned elsewhere. In just 48 hours, $5 billion flooded into Canadian markets from around the globe. The Toronto Stock Exchange lit up with activity, and financial analysts scrambled to keep up with the unprecedented surge in trading volume. Gold mining stocks soared, and the Royal Canadian Mint was swamped with orders. Demand for Canadian gold reached record highs as investors sought tangible assets to protect their wealth. The Canadian dollar surged, complicating life for exporters but boosting national pride. While some businesses worried about competitiveness, many Canadians celebrated their country's newfound financial strength. Banks scrambled to handle the influx. Branches extended hours, and financial professionals worked late into the night to process transactions and reassure clients. This was more than a windfall. It was a stress test for Canada's financial system. Central bankers met urgently to ensure stability, knowing the world was watching their every move. Investors weren't just moving money, they were moving trust. Each transfer was a vote of confidence in Canada's future, and a signal that the country had earned a new level of respect on the world stage. The U.S. had created a powerful competitor on its doorstep. For the first time in decades, Bay Street rivaled Wall Street, and the balance of power began to shift. This shift hinted at a long-term realignment in North American finance. Experts debated whether this was a temporary reaction or the start of a new era for Canada's economy. The world's financial center of gravity was tilting. International investors and institutions began to look north, considering Canada as a serious contender in global finance. The message: stability matters more than size. In a world of uncertainty, Canada's calm and steady approach proved to be its greatest asset, attracting attention and admiration from around the globe. The gold tariffs' shockwaves hit Main Street, not just Wall Street, affecting everyone. Jewelers in New York faced soaring costs or lost customers, struggling to stay afloat. Tech manufacturers relying on gold for electronics saw supply chains disrupted and prices rise significantly. Some considered moving operations overseas, undermining the policy's goal of protecting U.S. jobs and industries. Even American gold miners, many with global operations, faced new complications and possible retaliation abroad. The tariffs' unintended consequences threatened jobs and small businesses everywhere. For every market swing, real people worried about savings, jobs, and their future security. A single policy proposal had upended lives across the country, causing widespread concern. The gold tariff didn't just rattle markets, it challenged the global economic order. The US dollar's dominance relied on trust and stability. Now, countries like China and Russia accelerated efforts to reduce reliance on the dollar. Central banks bought more gold, storing it outside the US. The BRICS nations pushed harder for alternative financial systems. America's unpredictability became a rallying cry for a multipolar world. The structure of global finance began to fracture. U.S. economic influence, once unquestioned, was suddenly at risk. Alliances shifted, and new financial corridors emerged. The era of American dominance was showing cracks. The world was reorganizing in real time. The gold tariff was a catalyst for change. The future looked more fragmented and more competitive. As the dust settles, the world stands at a crossroads. Will the gold tariff become law or fade as a threat? If enacted, expect prolonged instability, trade wars, and a split gold market. The dollar's status as the world's reserve currency could erode. Borrowing costs and inflation might rise for Americans. If the proposal is dropped, trust is still damaged. Partners will diversify and prepare for future shocks. The world has glimpsed a more chaotic economic future. One message triggered a global chain reaction. The real question now: will leaders choose stability or disruption? The answer will shape the world for generations.